Hi, Natalie. Thank you for this. So let's go through the question very quickly because you've done all three, so you might just need to I might just need to refresh very quickly on what the question was really asking. So with audit risk, the question was talking about this company called Wimble and Co. who had become new auditors for this company. So that's the first thing I just want to highlight and pick up. I mean, it's not again, which is why I say that audit is it's a technical subject, and it's the kind of thing that you don't until you maybe do a bit of it, or you until you see a first question, then you suddenly realize, a lot of things are like, you have these moments because you're thinking, oh, of course, but you wouldn't know that ordinarily. So, I'm glad you didn't fall for this because this was an ethical issue. It says, having sold your shares, you've been assigned as the audit manager, you started the planning. These are all ethical issues, but not audit risks per se. I mean, truth is, if you were really scrabbling or scrambling for marks, you could find some kind of audit risk there in terms of it being some sort of inherent risk of sorts. But anyway, so Murray make sports equipment. Now, the key issue here is that it's your first audit. And generally, in every exam that you ever do, whenever you are dealing with a client for the first time, that's a risk. The risk that you don't know the client, they're new, you would have to do some more testing, some more substantive testing, some more initial risk assessment. Just because you don't understand the client, it's entirely new. It might be an entirely new industry. So that's a risk, first of all. So that's the risk you always want to start off with, which is why I was saying that typically in an audit exam, on your own, just looking at the scenario, you could probably come as close to 42, 43, but to just cross the line confidently, you want to put the standard things that the examiner is looking for. Okay, here we are. So we have this business here. We'll come to that anyway when we look at the answers. So this is Murray manufactures sports equipment, tennis rackets, take less than a day to make. So you can start to see the dichotomy there. Then these people here, this takes a week to make, and I think you picked that up. We'll look at that. And then, so there's an issue there. We'll talk about that. A week to manufacture. I'm hoping you're thinking, this is interesting. A whole week. So what's going on here? So in this paragraph, we're really talking about inventory, aren't we? Then it says here they've refurbished the assembly line. So if they refurbish the assembly line, everything, it might not look, it might just think, well, okay, but you want to be thinking, how does this affect my statement of financial position, or how does this affect my statement of profit or loss? So refurbishing will mean, I know we haven't done financial reporting, but hopefully you're thinking, right, refurbishing, even from taxation, will mean that these are capital expenditures that will potentially need to be capitalized. Has that been done properly? How will I check? Have they all put it through expense? Is it all remade up? Is it all improving the assembly line? Are they calling what are they really calling what redecorate? Are they really calling redecoration refurbishing? That sort of thing. So you need to be looking at some invoices, the actual invoices of the work done, to clearly segregate those that should be for capital and those that should be for revenue, and ensure the classification is correct. Then it says here they use a third party to manufacture to store. So there are issues there, aren't there? Because if you have a third party, will you have access to the inventory? Can you be sure that the inventory exists? It's valued at what they say it is, that sort of thing. So you can sort of see there already like 4 risks. So it says here, I think you picked up on this, and I'll come to your answers, of course. It says they have sold only to retailers. This is the first time they're doing it, and it's via website, so their chances are that there might be issues with the recording of revenue. I mean, it could be opposite. It could be the fact that revenue is overstated as a result of not I would have gone for not recording or not clearly documenting sales returns, because you're making all these sales. We don't know what's going on for the returns. I mean, it's potentially possible as well that it's not recording all the revenue, so revenue might be understated, typically unusual in terms of marking, but we are looking for risks. So, and there is also, of course, the question of controls as well. Here it says here we see a risk here that retail sales have dramatically, they're giving you the big word, they're dramatically fallen in the last 2 years. So here there's a potential that if revenue is falling, there's potential this business might be struggling even in the future. So there's a going concern risk, so to speak. Remember that as part of our audit, we need to give some indication as to the long-term viability of the organization. Some of them are struggling to pay their outstanding balances, so I'm thinking straight away. So trade receivables potentially overstated. Um, so I can look at some after-date receipts to see what's going on. Um, and several have been made redundant. So typically, like you say, with financial reporting, we need to kind of put some kind of provision in to because we can see this coming, so we should recognize that provision. And then, of course, it says it finally that they are planning for list on the stock exchange, so there's potential for manipulation. So I'm doing all my ratios because I need to know whether or not these people are trying to manipulate figures, because there'll be certain conditions for getting onto the stock exchange. Okay, so let's look at your your risk. So you kind of highlight. Oops, I thought I put this into PDF. Let me just see. Oh, well, sorry, of course. What am I doing? Here we are. Yes. So what we have here is you have picked up on the fact that this is stored at a third-party warehouse. So you're right here, increased risk of overstating or understating inventory. Yes. So what we need here, I guess from our conversation, you can see here, we just need to develop this here. You just need to kind of expand on how there is the potential risk of overstating or understating. You see, because with inventory, so much can happen. I mean, just the fact that it's stored in a third party warehouse doesn't mean that naturally this I mean, the question here is it's more for you as an auditor. The risk is that you don't have access. So that's what you're highlighting, the fact that you don't have access to be able to be sure, or will you have access to be to the to ensuring that the inventory does exist, if you like. So you can see here, you're right, there's a risk here of overstating or understating. So again, like I highlighted, typically what we're talking about here with inventory is the risk, more likely than often, is that inventory is overstated, right, due to a lack of access. That's the first thing. And also we need to also question the controls, if you like, over this third party. So for example, you have a third party warehouse. When I say controls, who is monitoring, or how do they look after inventory? How do they look after the warehouse? Is there potential theft? Potentially, I mean, are they housed in a safe, secure, um, temperature sort of managed area to make sure? I know this is we're dealing with metal or stock that should be okay, but these are the sorts of questions we're asking. So that's the risk here, right? And when I come to the answers, you'll see where I'm sort of going with that. Good here. This is a good one. It takes a week to make. So the argument is they're work in progress. Very good. So very much, really, it's less to do with the understating. It's the fact that the inventory is overstated, you see, because I always want to make my inventory look good. So what I'll say here is I'll say that I have WIP that is 70% complete, and I'll say there's been some material, there's been some labor, and I'll value it in such a way that WIP is higher than it really should be. You see where I'm going? So the risk is not really ever. So with inventory, we're always looking at the overstatement of inventory. Good. Yes, again, recording, but you have to expand a little on that. So you're right. This is good. There's a risk that list, but you need to kind of write a bit more. So you will need to do a bit more writing. And this writing, what you're here is you're really talking about the consequence. So write and expand on that consequence. Really key for you to expand on that, on how you think, exactly how you think that website will not be recording all the revenue as we see it. Very good. So this is a good one. The truth here is that chances are that although we haven't done it, I mean, by the time I talk about it, you'll see that research is expensed and development is capitalized. So the question here is we need to see evidence of capitalization, or the difference between revenue and development, to know that we give revenue through to the income statement and development is capitalized. So it's possible when you say assets, which assets? So the argument here is that a website is an intangible asset. Yes, it's an intangible asset. So you want to really be, like I say, it is technical but very doable. This is your first one. By the time you look at the answers, you'll be much more comfortable with reading. Again, very good. Yes, good, excellent. Excellent. This was good. Clear. Very good. So that's the issue here. Going concern. Good. So again, you can see, like I say, just on your own, most people would be happy close to 42, 43. We just want to make sure we're doing enough. Exactly. Exactly. Very good. Now you're getting the hang of it. So here, exactly. That's the issue here with trade receivables. So you're there. You're there. Right. So what I'll do is, and then let's look at so this was in response needing additional procedures in place. This was to the first one. So that was warehouse. Yes, good. Yes, so you're right there. Additional procedures in place to inspect the third party. So basically, you're really saying attend the stock count at the year end. Or whatever, if it's we'll come to talk about these periodical stock counts, which are done every month. Um, But the key point here is good and observing the adequate controls are in place, right? So there's a lot with inventory because first of all, the big thing about inventory when we come to audit inventory is that you need to be happy with the stock count, the controls. You really that's controls testing really at the stock count when you go and attend a stock take. You're trying to see if they because you can't count everything, so you're just wanting to be sure that the good controls are in place. Good. So discussions, very good. So, but not just in discussions, you yourself want to actually investigate and look at the invoices that have gone in. But you're right, there has to be discussion as to how do you standardize. But you're there, you're getting there. It's just making it a bit more specific. Um, good, exactly. Completeness of data, very good. So you see what's going on. Exactly. Reviewing, very good. Um, management will need to prepare forecasts. Yes. So what you're really doing is to, if you like you say, review and look at the sensitivity and viability of those forecasts regarding going concern. And this one, perfect. Checking post yes to see if they were paid after the year end. So this is your classic one here with that. Okay. So what I should do is let me take you um, to the answer so we can see the sorts of things they're talking about here that you will come to be have to be you will come to be comfortable with. Let me put it that way. By the time you do this, because you're going to do this question again, please, and literally after reading the answers and then write it to the answer, so to speak. So, like I said, this is the first year, right? And the consequence, you write the audit risk, you almost need to state the consequence here. The consequence, the big consequence here is you want, again, such a technical subject, we want to say this. It's about the opening balances. It's not about anything else. It's about the opening balances. Can we trust the opening balances? It's your first year. They may be misstated. So your very starting point is potentially flawed, right? Um, Here we have detection risk. Is yes, of course, detection risk is increased. There's a lack of knowledge or experience on this particular audit. So you can see the response here. Like I said, more time and resource are needed to obtain an understanding at the start. You will have to carry out more substantive procedures, like everything at your first year, and you will need to verify those opening balances, probably by checking them to last year's working papers, speaking to the previous auditors. So typically, the previous auditors will send you, um, if you like, they should send you some confirmation of the final figures from the last year they did them. Typically, they'd send you all the closing balances, and if they've signed off on them, then you can trust them. So what we were talking about with inventory, which you kind of highlighted. So the question is, it may be difficult. This doesn't mean it will be, but we cannot assume because we don't know where this warehouse is. So if there's going to be an issue with obtaining evidence over the quantity and condition, which is measuring whether or not there's increased risk over is it all there, does it exist, and the valuation. So like we said, you want to attend the inventory count um, to review the controls in operation. All inventory counts are about controls. You're not really valuing at that particular date. You're valuing post the inventory count to see whether or not inventory is sold lower for higher than cost ultimately. And then, of course, we want to really understand the controls in place, like you said, over the inventory from the third-party warehouses. So what they do to ensure that goods coming in stay in and they're not stolen and they're recorded correctly and the cutoff is right, that sort of thing. And then, of course, how the inventory is kept, that sort of thing. Like you said, perfect. You talked about work in progress, so material work in progress. Big word. We want to highlight the fact here that though there might be material work in progress, and this has always been a complex work in progress is just complex. So there's a risk of misstatement. I guess I argued overstatement. I guess misstatement is enough. It's probably better than overstatement, but typically it could be overstatement. So, like you said, assess, look at the discuss in terms of how management arrive at that, and you want to look agree to supporting documentation. Um, WIP should be agreed. Yes, so look, like I said, you want to look at all the purchase invoices for materials and timesheets. So you're, like I said, our audit responses are very direct, very clear. We're actually doing something, right? And it's almost asking what test would you do, so to speak, to be sure that you can guarantee that figure. And then, of course, what's also really important is that work in progress typically will have overhead. So this is where a lot of the overstatement comes in. The fact that production overheads have to be absorbed into that product. You might remember from performance management. So you would make your item, and then you would have direct materials, direct labor, and then you would also have some overheads that have been put in there. So, like you mentioned, I think I highlights the fact that it's been refurbished. So it's easy one to miss. It's just one line, but it's important here. The question here is, what's going on with that refurbishment? Is it all capital? Are there some revenue elements there? So you want to literally just see a breakdown of all the invoices on repairs, on what they're calling repairs, and pretty much assess them and check them to the invoice to be sure that those things are actually repairs and what's capital. So you're right here. The question here is, has all the income been recorded? So if either income revenue is understated, so this is very much a controls test. So controls test to look at the sales cycle and test things to see whether or not they have been recorded and have transferred into revenue safely. So fundamentally, you're looking at these. This is almost like performing a walkthrough test. You're putting an order through to see whether it gets through and whether the sale is delivered and is recorded in the sales daybook is ultimately what we're trying to do. Well, ultimately, the other thing about this, interestingly enough, is that these were cash sales, so we shouldn't really be seeing it spent too long. We shouldn't see it featuring in trade receivables because we see that it's all for cash. So here, where I highlighted, I know you haven't done intangibles so much under financial reporting, but the key point here is that the risk here is that intangible assets and therefore profits, because if it's expenses, then they should go through, right? If you're capitalizing what's essentially a research expense and you're calling it a capital expense, then you are, if you like, avoiding it or preventing it from going through the income statement. So you want to see a breakdown of that expenditure. So you can see it's the language. The language is the same all the time. Give me a breakdown of that expense. So basically, take the expense code in the income statement. That's what we would ordinarily do. Find out, just literally go on to say, not I was going to say Sage or whatever software it is. Get a breakdown of it. Literally look through everything. Maybe pick some high ones. Look for the purchase invoice relating to them, and see for yourself whether or not these are capitalized. They should be capitalized or expensed. And like you said earlier on, so you can see there's a bit more of a discussion you need to do. So you weren't wrong. You just need to expand a bit more. If this continues to fall, they may not continue to operate for the foreseeable future. So, like you mentioned very clearly about disclosures will be required, ongoing concern. So you can see here that you said what you're looking for is a cash flow forecast, really. So that's language. This is just all language you're now going to learn and use, if you like, and looking at those contracts with potential customers or existing customers, and see what's going on with potential customers in the future. Um, Again, I think okay, this is something you need to pick up on, but I'm highlighting it. You haven't done it, but really the argument is that you might remember that the fact is that if you are expecting a cost, you should create a provision, right? But we'll come. These are little things you'll come to pick up on, but they're not major. Even though we haven't done financial reporting just yet, you can still be very much all right. So the key question here is that there is a provision, and if they've not been paid, if you're going to have this redundancy, you need to recognize the expense or debit redundancy, credit, provision, liability, really. Um, And really, again, you can see here you're discussing with management regarding the provision. But again, you needed 6, so you would still have been all right even if you didn't pick up on that. Right. So again, here, like you said here, risks of overstatement of receivables. So the question here is, we need to review post year end. That's the best most of the time, post year end, and review the age receipt to see if there are any others. And then, of course, here there's an increased risk of manipulation because they're wanting to list so overstatement of assets and profits and understatement in general. So you're being much more focused and aware of these risks. So again, I think what's good, I mean, I know this is the first time you were doing that. So I'll just come here, and I know this was out of 12. So the truth is, I mean, typically this is how I mark these. So to be fair, what I probably will give you here, first of all, as a grade is 5/12, just to show you that really it's not that you don't know it, it's just that we need to get that language right. So my recommendation, please, is that again, like you say, once you get it, once you click into it, you get it. Because as soon as you start saying, well, it's the first time we're doing it, so there's going to be a risk, first year contact, we need more information, we need to carry out more substantive testing, we need to carry out more controls testing, then you see you start to getting all the little half marks that get you over the wall. Cool, great stuff. Thank you.